Hi everyone, thanks so much for joining another Market Live, the start of a new month, the start of the second half of the year. And what a start it has been. There is so much going on in markets at the moment. Obviously there are payrolls which are coming up and we will dive into the charts and we will look at those in a second. But I also wanted to say that we're also looking at what's going on in the UK. We've got US Treasuries in focus as well because we've got that budget in the US. And of course we've got the deadline for reciprocal tariffs. That is next Wednesday. So a huge amount going on. Let's dive straight into the charts and we will follow up with everything that's been going on. I just want to show you just a brief overview. This is obviously for those of you who join me regularly, this is our World Equity Index page on Bloomberg. I love it. It's the first thing I look at every single morning or whenever I kind of go onto Bloomberg because it just gives me the snapshot that I need. As you can see, a bit of movement here in European stocks. By and large, European stocks kind of neutral, totally to be expected as we wait for this, but a big outperformer there, the FTSE 100. Some weakness in the pound always tends to lift the FTSE 100. Also, we are seeing just a little bit of recalibration there in the bond market. Now, yesterday, we did see a big move in UK bond yields. Now, as you can see, they have reversed some of that move. So if you follow my pointer here, this shows you the change in yield on the 10-year UK gilt. It's down 7 basis points, 7.4 basis points on the 10-year. Let's just take a quick look at what the 30-year is doing, down 8.3. Now, let me pull up that chart, the UK 10-year chart. And the reason why is because unless you were kind of looked at no news or maybe you were under a rock or something, then you will have missed what happened yesterday. So yesterday, obviously this week has been very, very big for the government. Yesterday, it really looked like the Chancellor was very upset during Prime Minister's questions, potentially because she was about to be sacked. And as it turns out, the bond market really has Rachel Reeves back because bonds absolutely surged. Look at that. If you follow my pointer, we surged, we jumped some 20 basis points nearly on the back of expectations that the Chancellor could be let go because there's obviously been this whole debacle with the welfare bill. She was going to take the blame for it, but the bond market, they really did dictate the fact that she keeps her job. Now, this is all hearsay, obviously. Apparently, it's a personal matter that she was upset, but there is a lot of expectation that it was because she was going to get fired and then he was going to replace her with somebody. Keir Starmer, the Prime Minister, was going to replace her with somebody. Obviously, the fear for bond markets is that the left of the Labour Party have really been emboldened by the welfare reform. That's what's caused this huge spike higher in yields. UK was a major underperformer yesterday, so yields absolutely shot out. They really started to glare out like a sore thumb again. We have seen this in the past with UK yields again as well. And I'll just put into some context this move because I think it's useful. So if I go on zoom out a little bit, you'll see yields were higher, but they hadn't really risen to the high from earlier this year. However, that's not the point with bond yields always. Sometimes it's the scale of the daily move. So if I go to percentage one-day change, this is percentage one-day change in yields. So it's not exactly perfect, but as you can see, an absolute spike higher here. As high as the move that we saw in April. Now, we have obviously come back down again today. This is very, very choppy. But if I zoom out again, this is just a one-year chart. If I zoom out again, then you kind of get to see it. I won't do 5 years because obviously it's all really distorted with COVID. But if I go to 2022, then you can really see this was significant. So that's a peak. We had a peak there in April. Then before that, we had peaks at about the start of 2024. We obviously then had peaks in 2023, and then we had this massive surge in 2022. So it really was as high and as big, that move in yields, as we saw in 2022. That was the Liz Truss budget. Can we ever forget that? So it was a really significant move. And I think what was even more significant was the drop in the pound. So at the same time as bond yields were spiking, this is the cable rate on just 3 days worth of cable. We really saw that climb down, and we've retraced about 50 to 60% of that move now, but we haven't got back to those highs. So those highs of the week so far came in above 137.30, currently trading about 80 points lower than that, 136.80. Sorry, 136.50. 136.5 there. So we're really not retracing those highs. And I think it's just worth noting that, this chart is just fascinating for many reasons, but it does suggest that the UK is kind of lurching from fiscal mini crisis to fiscal mini crisis. And there was one of those yesterday about who the Chancellor was. That doesn't just suggest that our finances are in good shape. It definitely suggests that we need to get public sector spending under control and possibly cut. So the government's going to have to really man up and face up to those backbenchers and really cut spending, because that benefits bill in particular is very, very large, and it's really, we can't really afford to have it. And that's what the bond market is basically saying. I think there's also some element in the bond market there that are really worried about tax hikes as well, because when you've got a really big national debt like the UK does, obviously you've got to have a level of tax. The UK does have a very high level of tax, but it was the fear of what that would do to growth. So high debt, low growth, profligate government, that's not a good mix. So the bond market really did try to give the Labour government a big warning yesterday, on par with what we saw in 2022 with Liz Truss. So this is just today. The pound is actually one of the top performers. We're not seeing too much movement there, but it is the top performer in the G10 FX space, just erasing some of that loss. But we have got a strong dollar as we lead up to this payrolls report. We're 4 minutes away now, and I will follow it so that we see everything and live. I'm also showing you the E-minis. So this is US futures. So US futures prices just backing off the high there. The one thing I would say, I found something super interesting just before I came on this call. The bar to a surprise for payrolls is actually quite low. The standard deviation of payrolls versus the forecast is only 18,000. So the forecasts tend to be right. Very, very different to ADP, which was the private sector payrolls that we saw earlier this week. That came out much weaker than expected. In fact, it was a loss. So private sector payrolls fell 33,000 last time. But as you can see, just kind of extending the downside there as we lead up to this data. So I'm going to just go onto the data page, just to show you guys what is expected. And as you can see here, change in non-farm payrolls. This is the Bloomberg expectation. Is the latest expectation, or the expectation, is 106,000 with 100,000 change in payrolls, in private sector payrolls. So very different from that ADP report. But remember, those two things do not move together. So 106,000 in payrolls, that's quite weak, quite low. It does suggest that the unemployment rate will eventually have to go up if that is correct. And if we see a number of months at 100,000, because you really need to be creating 200,000 jobs in the US to maintain the unemployment rate at a low level. And lo and behold, the unemployment rate is expected to go up 4.2 to 4.3. So just a very small notch, but that would still be the highest level since 2021. And that could be the focus. If we get a higher than expected unemployment rate, we could really start to see a big repricing in interest rate expectations. I don't think there's going to be much. Oh, where am I going? Sorry, I'm going to go onto the work page now. I'm juggling around everywhere. But the work page, this is world interest rate probability. And this is for the US. Currently, rates are between 4.25 and 4.5%. There's a 25, you follow my pointer here, 25% chance of a cut in July. Now, that has risen from 20% earlier this week on the back of that ADP report. So not a massive increase. And we don't think it's going to be them. But look at this, a 95% chance of an increase in September, a 68% chance of one on October, and a 78% chance of one in December. So if I just go down here, we're looking at about 2.5 rate cuts currently priced in, just over that, probably more like 2.6, 2.7 since the pricing for the Federal Reserve for the rest of this year. And I think what we could see is that we really push to 3. So definitely an expectation of kind of 3 rate cuts then by the end of this year. So just bringing forward those cuts. So we're getting kind of, consecutive cuts now, some big expectations, possibly move up into the 90s if we see a worse than expected unemployment rate. So these are all some quite key events. Let's get back on that. Yeah, we've only got 25 seconds now before we get payrolls data. So as you can see, payrolls is 106K is what we're looking at now. The payrolls report is obviously the gold standard for US labour market, but it is one of just a few. There are other data points, as you can see, coming out today. Initial jobless claims at the same time, which we'll watch. They're expected to increase, but remain at a very low level. We've also got average hourly earnings expected to edge down a notch. Right, so where are we here? Okay, 147. stronger payrolls than expected. Let's take a look at that, that unemployment rate, 4.1%. My goodness, this is all going the opposite direction to what was expected. So everything I said about interest rate expectations, expect a bit of a reversal. So I would expect the market now to be pricing out expectations of rate cuts for September. I'd say expect that now to drop down to the 80s, maybe even the 70s level. Underemployment rate, that also dropped to 7.7 level. Average hourly earnings also lower a notch, just to 3.7. Initial weekly jobless claims also very weak. So what's really interesting, that JOLTS data that we saw earlier this week, that has really come down. So let's see what that's done to the market. Yeah, the pound's taken another dip lower. That's not because Rachel Reeves, anything has happened with Rachel Reeves or the government. That's because the dollar is stronger. I'm going to bring up dollar yen, which is typically very sensitive to payrolls. But this is a big move for payrolls because the standard deviation is, so the difference between the forecast and the reality is very, very large. So look at this, look at that spike higher in dollar yen. We've gone from 143.80, we've jumped a whole 100 points there to 144.80. We're just backing away from there a bit now, but I'm comfortably above 144. Let's just zoom out of that dollar yen chart just to give you a bit of context. So we're quite weak, but I want to show you something, a series of higher lows. And that's what we could be in here, that actually we put a nice low in there about 143.5. And we could continue to move up there. So look, 144.90 now, so it's moving higher again. 145 has to be on the cards on the back of this. I just want to see, we're not going to see too much initial movement in payrolls data, but it's interesting what it will do for equities here. We could actually see a bit of weakness in equities purely because we would expect to be seeing, sorry, I'll go back to that equities chart, purely because we would expect that, there's a lower expectation of rate cuts from the Federal Reserve, which could weigh on stocks. Remember, going into this payrolls report, the S&P 500 reached a fresh record high yesterday. That is huge news and something that we have been watching closely. It is tending to back away a little bit though, and we think that we could potentially see a bit more weakness in this S&P 500 futures market. Remember, the US equity market doesn't open for another hour. Now, I want to show you as well let's take a look at the yields are doing in the US. We would expect yields, yeah, there you go, a big turnaround in yields there. Yields are higher on the day in both the 10, the 2, just across the whole curve. The 10-year is up 7 basis points. The 2-year now is up 10 basis points. That's because we've got a recalibration going on of rate cut expectations. Let's pop back to that work chart. We haven't seen too much movement, but it does take a little while to filter through on this. So I think that we're going to see a massive reduction. Basically, they're not going to cut rates this month, on the 30th of July when they next meet. I think that that's going to be massively scaled out. And I also think we're going to see a bit of a drop in expectations, maybe to the 75, 80 level. Right now, 95% chance of a rate cut in September, but I just don't think that is going to be reality. Let's take just a bigger, deeper dive into these payrolls to see what's going on. We'll just wait for this to come up. Sorry, it takes a little bit of time. But yes, the June number really led higher by government workers. Doge, you know that Elon Musk is out the door when that happens. So there's a lot of rehiring of government workers. We've also got education and health services. They've been a big strong provider of jobs, and actually very few have been cutting jobs. So we saw other services, tiny decline in professional and business services, but it's really been driven by government job creation. Now that is really key, because remember, under Doge, under Elon Musk, we saw that real decrease in and job cuts for the government, for the federal workers, for government workers. Well, it looks like now with Musk out the door and this big fight between him and Trump is almost doing, I don't know, maybe revenge hiring of government workers. And we're actually seeing a really big increase there. So that is one of the largest increases. So how big is that? So that's 73. I would put that as one of the largest increases for quite some time, since well over a year. So yeah, probably looking back to kind of early 2023. So that really is something. And actually, if that continues, then we could see a more buoyant labour market than some had anticipated. I just want to go back to that chart, to that data as well. Remember, as I mentioned, payrolls is just one part of a bigger puzzle. I'm sorry, I put it up in the UK there. I didn't mean to. Let's go back to the US. We've had a huge amount of data. We've also got the trade balance. Yeah, so the trade deficit has widened a little bit. We've got exports. They were down in May, totally to be expected. Imports, they were down just a touch though, and a big pickup from April. Do you remember we saw that 16% drop in imports in April? Well, that's now just dropped to 0.1%. That's because of the, and we would expect the same for June really as well, because that's when Donald Trump really changed things around, and he really said that he was going to, when he paused the reciprocal tariffs, that's having a big impact on this data. So lots of volatility in the trade balance, lots of volatility in the numbers. So more imports there, weighed on the trade balance. The deficit's got a bit wider, a little bit wider than expected, and much wider than that April figure, which was 61.6 billion deficit. It's now 71.5 billion. So a lot of weakness there. Now, later on today, we have this ISM service data for June, the final readings. But I think, it's all about this stronger payrolls today, and that really is having a huge impact. Let's go back to let's go back to US Treasuries, because US Treasuries really do. Where US Treasuries go, that's where the dollar goes, usually, when it's working correctly. As you can see, massive surge higher in two-year yields. Two-year yields surged from 3.76 to about 20, to 3.96 there. So we've really kind of backed away there. We're now currently trading around 3.87. That's an increase of 10 basis points. So a very large increase in this recalibration of what to expect from the Federal Reserve. Let's go back to the work chart to see if that's had an impact. Yeah, again, we've seen a bit of a pricing out, but I think it's pretty clear now that we're going to get the cut. The market is very convinced that we're going to get the cut in September. Little bit of reduction in expectation for October and December. And I think we'll probably settle around the 2 cuts. So more of that could be priced out. But this is just updating very, very slowly, because it's an interest rate futures market, slightly more complicated market compared to where else we are. And as you can see, the pound has found good resistance here, good support here at 136. So it has really, this payrolls report has not benefited the pound at all. But where we are seeing just that divergence and that slight recovery in the pound is in these is in the bond market. But even that has given back some of those gains, because the bond market, sovereign bond markets, particularly highly indebted nations, they're kind of moving in unison. So when US yields rise, even though it's nothing to do, and the chancellor is still in place, I should add, we're seeing a knock-on effect. So we've seen a bit of a drop, or increase actually in the gilt yields on the back of that, because they are kind of moving together. But it's all about the 2 years. There we go. So it's all, again, nearly up 10 basis points. That is kind of crazy. We're seeing a little bit of so stocks have the real shine have come off stocks. And we think that US markets, they might struggle to make a fresh record high today on the back of that. That's quite a big surprise. As I said, the average surprise has been only 18,000 difference between expectations and the formal, the official non-farm payrolls report. That has now really been blown out of the water. So we've got kind of 38,000 difference on the upside for payrolls to what was expected. So that's something there. But guys, thank you so much for joining. It's always such a pleasure to have you on here, and the month's just absolutely whizzed by. No doubt we will speak again in August. We've got lots going on, so still lots to trade. This is big news, actually. Payrolls report can really set the tone for the dollar in particular for the rest of the month. So this has really given the dollar a boost. So we expect that to be the case. But thank you so much for joining, and please do join us next time.